Hey, friends. Hello, hello. How are you today? Welcome to today's market take mentoring Firstrade presentation. Today, we are going to be talking about exploring strategies to generate income and manage risk. Now, before we talk about that, I want to make sure that you can hear me. Because if you can't hear me, I'm not doing anybody any good if you can't hear me. So hit that questions box for me and give me a big old yes if you can hear me. Hit that questions box for me and give me a big old yes. All right, Mark. Yeah, that's what I like to hear. Hector is chomping at the bits over here. Hector's been ready for like 10 minutes over here. All right. Thanks, Mark. Thanks, Justin. Oops. And thanks, Mike and Shane and Scott and anonymous attendee, secret agent man over here, Flora, Mary, and my good, excited, enthusiastic friend Hector. And it's Larry. Hey, what's up, Larry? Good to hear from you. All right. So today we're going to be talking about exploring strategies to generate income and manage risk. But before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And, you're in charge of your own destiny, man. I'm not giving you advice. I'm just trying to help you learn and understand options better so that you can trade for yourself and make your own decisions. That is called empowerment, friends. Now, allow me to introduce myself. I see some new faces here, along with some old friends. So, for the new folks, let me introduce myself. My name is Dan Passarelli, and I am an author of two popular books on option trading. Trading Option Greeks is the one that I'm very known for. Nice to meet you too, Hector. Trading Option Greeks is the one that I'm very known for, as well as The Market Taker's Edge. And my upcoming book, which won't be out for another year or so. I'm still in the process of writing that. And I've written somewhere around a gazillion articles and other things. I do a lot of content. Also, I am a trader. I trade every day. I was a professional trader on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, CME Group. I made the rounds in Chicago. And I still trade to this day in my account. I'm the founder and president and CEO, chief dishwasher of Market Taker Mentoring, which is actually the global leader in option trader education. We have students in well over 50 countries. We've trained tens of thousands of students to trade with options and invest with options. And I am a trading industry collaborator. I work with lots and lots of good folks in the options industry. For example, Firstrade and many other brokers, many other exchanges. In fact, just about all the global exchanges that have to do with options, I've had some sort of interaction with. And what else? What else? Oh, yes. The important things here, right? Trading, all that can do is make you rich. The important things in life are family, my wife Kathleen, my two adult children, and things that I like to do to help me enjoy life besides trading and investing. I'm a runner, foodie, traveler, music person. And that's enough about me. Let's talk about you, and let's do this. Today we're going to be talking about exploring strategies to generate income and manage risk. And so I'm going to give you a free gift. Go to markettaker.com/guide and you will get this guide, Option Credit Spreads Explained, and that will talk about income generating strategies, specifically credit spreads. And that is my free gift to you just for being you and being here. Okay, so let's talk about how to generate consistent, predictable income using options. So, look, I hate to break it to you. I know the best traders here already know this, but option trading is not about predicting the stock price or the option price or anything. Trading is not about predicting. What trading is about, option trading or otherwise, it's about using quantifiable statistical measures to predict potential profits and to optimize risk reward. In fact, I don't even think we need that word predict in there because it's not about predicting at all in any way. It's managing a sea of uncertainty to make smart decisions that can generate profits. A very, very successful person, Warren Buffett, said, take from the market, don't get taken by it. And this is a quote that I really love to see of his. I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. Darn, man, doesn't that just sum it all up? All the folks who are dumping their stocks right now, stocks might be down for another week, another month. Heck, they could be down for another year. But you know what? 2 years from now, 3 years from now, 5 years from now, I can't guarantee it. I don't know for sure. I can't predict the future, but I think they're going to be up significantly 5 years from now. That's my best guess with the data I have. Be greedy when others are fearful. That's what Warren Buffett says. And I kind of like that. I kind of like that a lot. And when we do that, whether it's trading or investing, I mean, Warren Buffett, he was a value investor. A lot of my work is done with trading, although I've been doing a lot of work with investing recently as well. I think that's pretty darn good advice, whether you're a trader or an investor. So now let's focus on trades, income trades specifically, and edge. Edge? What is this Passarelli guy talking about edge? We need to define that, don't we? Well, let's do that. So let's play a game, shall we? What if, do I have any coins around here? I don't have any coins around here. But if I had a coin, and every time I flip it and heads comes up, I give you $1. And if tails comes up, I give you nothing. Who wants to play that game? Give me a yes if you want to play that game. Give me a no if you don't. I flip a coin, heads comes up, I give you $1. Tails comes up, I give you nothing. Thanks, secret agent man, anonymous attendee. Yes. That's the same hexadecimal code on the paint as it is on my slides. That's right. So Shane wants to play that game. Larry wants to play that game. Secret Agent Man, anonymous attendee, wants to play that game. Justin wants to play that game. Matthew, I like the way Matthew thinks. Free entry? I don't think that makes sense for me to play that game. If I'm the guy giving out dollars, I think that I think I should charge you to play this game. Now, what if I charged you to play that game? Would you still play? If I charged you to play that game, oh, Matthew wants to know how much. Well, Matthew is asking all the right questions. What if I charged you $1 to play that game? Does that sound good, Matthew? I mean, you know, you get $1 sometimes, you don't get $1 the other times. Would you play that? You'd rather go to a casino? Yeah, well, that's right. You'd get better odds. How about, let me turn the tables on you, Matthew. How much is the most that you would pay to play this game? How much is the most that you would pay to play this game? Let's start the bidding. Da-da-da-da-da-da. Anybody? Mark is asking some good questions as well. How many coin flips? As many as you want. How about that? Or until my thumb breaks from flipping, flipping. As many as you want. Oh, Scott, you're going to get left in the dust if the most you would pay is 0. You're going to have some people in line in front of you pushing you out of the way because, and we got a whole bunch of right answers here. So thank you. I'll mortgage my house. Yes, I would too, Mark. I would too. So we got a lot of right answers here. So here's the idea. If 50% of the time you get $1 and 50% of the time you get nothing, and you can make this coin flip as many times as you want, thousands of times. That means 0, like here's the math, right? 0 times 0.5, 50%, plus $1 times 0.5, 50% equals 50 cents, right? If you're allowed to flip that coin thousands and thousands of times, each coin flip is worth 50 cents on average. Now, don't get me wrong. Sometimes you're going to get nothing, but sometimes you're going to get $1. But on average, you're going to get 50 cents. So if I were to flip that coin thousands and thousands of times, and you were to play that game thousands and thousands of times, you would pay anything up to 50 cents. You might pay 50 cents. At 50 cents, it's what you would call a fair game, and it would be gambling for both of us. You might win a small amount, lose a small amount. Anything less than 50 cents, it goes from gambling to being a business. If you pay 49 cents for something that's worth 50 cents, you make a penny every time you flip it. Flip it 10,000 times, you're going to make, well, $100. Right? So that calculation that I gave you, this concept that we're talking about, what we're talking about here is expected return. If you pay 40 cents for a coin flip, that's expected value is 50 cents. Your expected return is a dime, 10 cents. That's your edge. And that is a real edge. Now, if you could only play the game once, it's kind of a gamble, but technically it's still edge because maybe you could only play that game once. But if you played every game in your entire life in that same manner, even if it's different, you know, if you're always getting edge, you will come out ahead. That's the whole definition of ed. That's the math behind it. Matthew says to scale this, I would have questions. Oh, yeah, yeah. Is the coin a fair coin? Is it an actual coin or a virtual coin flip simulator? Can I flip it as many times as I want? Is there an end date or time to this offer? Right. And exactly. You know what? When it, read the fine print. I was talking to I was talking to a friend of mine the other day, and I haven't talked to him in like a long time. Like I used to stand on the trading floor with him. He was like probably one of the top three smartest guys I ever knew in my entire life. And like about 3, 4 years ago, I went out to dinner with him after not seeing him for like over a decade. And I just went out to dinner with him a couple of weeks ago after not seeing him for 3 or 4 years. And he's like, "Oh yeah, I flew to Delhi." Um, I was like, "Delhi, like India?" He's like, "Yeah." I was like, "Oh, what'd you do there?" He's like, "Nothing." It's like, "Well, why did you go?" He's like, "Oh, because it was a really, really cheap flight that I could get business class, and I was able to get a ton of points, like airline miles, for it. And it's the cheapest flight relative to the number of airline miles that you can get." And then, we're talking about, I was like, "Oh yeah, I've got, a United card and I get those points." He's like, "Oh yeah, there's a better card for this." And like, you know, he's got these like hustles. And, truth be told, I do some of this as well. And, it's reading the fine print, whether it's credit cards or airline miles or whatever, you can turn that stuff into really great value. You can turn a coin flip into really great value. If you're like Matthew and you want to, uh, oh, you did, Matthew? See, okay, no wonder you're asking all the right questions and talking about the fine print. Oh, they don't work as much anymore. Oh, okay, interesting, interesting. I used to fly so much. I for a number of years, the Chinese government was flying me out there to teach, well, teach their exchanges and brokerage personnel options, which was pretty interesting. So I used to get a ton of miles just for doing what I do. So never really had to work the hustle too much. But yeah, now I probably ought to somehow. But anyway, the idea here is that is that with this coin flip example, with reading the fine print on credit cards and seeing if you can, make it a value proposition, but especially trading. When we're smart and we put the math on our side, we can get what we call edge. And it's not, we don't say an edge. I mean, we can say an edge, but it's edge. Um, so interesting, Matthew. Interesting. Interesting. All right. So, how do we get edge when it comes to option trading? I'm glad you asked that question. There are market makers who are the people who supply the bids and the offers, and they get their edge by buying below what the option is worth and selling above it. And a lot of times it's pretty tight spread, the bid-ask spread. Sometimes wider in some, but sometimes tight. But we don't have that luxury. We have to trade, we have to buy closer to the offer and sell closer to the bid. Sometimes we can middle the market, but we can seldom trade right in the middle. Sometimes with the very liquid names like SPY and Apple, sometimes we can, but with most stocks, we can't. We always have to give up some edge to the market makers. But I used to be a market maker. I understand how that game works. The one thing that market makers don't have the luxury of doing is analysis. Option trades have a lot of moving parts, right? They have delta, they have theta, they have implied volatility, they have interest. We must get edge from all sources we can. And in order to do that, we need to have a methodology. So that methodology is this. This is the market taker, well, 12-step program, I guess, right? This is what I call our trading path, all 12 of these steps. But I only want to focus on what I call the big four. Analyzing the technicals, analyzing the news, which is the fundamentals, basically, analyzing the volatility, and using that forecast from that to select the optimal strategy. Those are our four biggest sources of getting an edge on our trades. If we're good at technical analysis or good at fundamental analysis, good at volatility analysis, and we can use that to select the best trade from a risk reward and probability standpoint, I believe we can trade better than other traders and be potentially more profitable. So what are income trades? So income trades are a family of option strategies that benefit from time passing. How do we benefit from time passing? Well, options lose value as time passes, right? That's called time decay or erosion. So the idea here is just the opposite. Well, it's not the opposite of buy low, sell high. It's that, but it's just the reverse order. Sell short high and buy back low, or just let them expire, which is like buying them at zero. So there's some common characteristics of income trades. First of all, positive theta, which is how we measure how much we profit on any given day by time decay. Negative gamma, which means movement hurts us, and usually negative vega. All the trades we're going to talk about today, which are credit spreads, do have negative vega. So there's two types of credit spreads, call credit spreads and put credit spreads. Call credit spread is when we sell a call, usually out of the money, and then buy a higher strike call for protection. Basically, the call we're selling is the trade. That's the one we're trying to make our money on. The call we're buying is the insurance policy, the protection. Put credit spread, same thing. We sell a put, typically out of the money, lower strike than where the stock is. So we buy an even lower strike for protection. Let's look at some examples on this. So we're looking at this stock, and this is just, this is a static screenshot on a PowerPoint. Prices are not current, first of all. And this is just a very hypothetical example, not a recommendation or suggestion or anything. I want to teach you how this works so that when you spot it in the future, you will be empowered and be able to act on your own with knowledge that I hope to give you. So here we're looking at this stock and we see that there is some support at $42.50. Okay, what does support mean? Well, support means that if the stock gets down to that point, it's shown that it tends to bounce off it. Now, There is some support a little higher. There is some support a little lower, which is great. We would like to have several levels of support. And we can split hairs about what the strongest level of support is or where exactly it is. But again, just a hypothetical example. Here's the market taker methodology of trading credit spreads. When it comes to put credit spreads, we want to sell the put at or below support. So if support in this hypothetical example is 42.5, I could sell the 42.5 puts and buy the 41.5 puts, a lower strike, right? So if I sell the 42.5 puts at 53 cents, buy the 41.5 puts at 28 cents, I end up paying what? 25 cents, right? So how does that look from a risk reward standpoint? Well, let's take a little look-see here. So if I sell, okay, so the stock is in this example, $43.57. We're imagining that there's support at $42.50. And that's where we're going to sell the put. And then we're going to buy that lower strike put at $41.50. So it's a dollar wide spread. And I sell it for 25 cents. Who can answer this? How much is the most that the trader can make on this trade? How much is the most that the trader can make on this trade? Who can tell me? Anyone? Bueller? 25 cents, says Scott. 25 cents. That is the maximum profit. Now, Secret Agent Man, anonymous attendee, says, tell me, if the market moved against you, how did you do to generate profit? Well, if the market moves far enough against you and you take no action, you lose. But here's how this works. Scott is 100% correct. Scott says 25 cents is the maximum profit. So let's say I sold these at whatever, 58 cents, bought these at 23 cents or whatever it is, collected 25 cents, and the stock stays above both strikes. Okay, it was at 43.57 and could have gone up a little bit, could have got down a little bit, as long as it stayed above 42.50. And I did nothing. I held it all the way until expiration. What would happen at expiration? Well, both of these options would expire. And so the 25 cents would be mine to keep. So to answer Secret Agent Man's question here, part of your question, because it's actually a very good question, by the way. If the market moves against you, how do you generate profit? If the market moves against me, and in this case, moving against me is down, but it's forgiving. If I move down some, it's okay, and I actually can still make a profit, as long as it doesn't go down below 42.50. But in fact, even if it goes a little bit below 42.50, I still end up with some bit of a profit. Because if it's below 42.50 but above 41.50, I end up getting assigned on this put, therefore getting long stock, long at 42.50. But I also have that 25 cents. So effectively, my tracked cost basis is $42.25. That would be my break even. So really, as long as I'm above $42.25, I make money. But if I'm below there, I do indeed lose money. But I have a limit on how much I can lose. Who can tell me what the most I can lose is? Got some smart folks in here. Who's going to be the first one? But almost, Scott, almost. Think it through a little better. I know you're going to get this. It's a dollar wide spread. I collected 25 cents. There you go, Mark. Nice. The most I can lose is 75 cents. There's a couple different ways of thinking about this. One is, well, my break even is 42.25. So so that's where I would effectively get long the stock. If the stock is below 41.50, I could exercise this put and sell what I bought at effectively 42.25 and sell it at 41.50. So I would lose 75 cents. A better, probably an easier way to think about it is the most this spread can be worth is $1 because the width is $1. Buy it at 42.50, sell it at 41.50. It can be worth, $1 loser, but I get to keep the 25 cents. So either way, so the most I can make is 25 cents, most I can lose is 75 cents. And, a good way to check that math is my maximum profit and my maximum loss is always going to add up to the value of the spread. All right. Good work, everyone. Good work. Good work. Max gain is credit received. Max loss is the high strike minus the low price minus credit received. Okay. So what's the best way to trade these? Okay. I showed you how they work. I gave you a little bit of a clue there with support and resistance and all that business. But let's really drill down some here, okay? I want you to walk away from this class today with knowledge in hand and be able to repeat this. Take action. I want to empower you. So we're going to start with direction, which we mainly want to use technical analysis. We want to find a stock that hit support or resistance and bounced off it. Support or resistance has been established. And we want to use support or resistance to set the potential short options strike. With a put credit spread like we just looked at, we're going to use support. With a call credit spread, we're going to use resistance. And then we're going to move on to volatility, to implied volatility. And this is kind of a pro tip here, okay? We're actually only going to sell the spread if implied volatility is elevated. High. Why is that? Because implied volatility is basically how cheap or expensive options are. If implied volatility is high, that means the option is expensive. And we've talked about how to measure whether implied volatility is high or not a couple of times already in a couple of the classes. If you didn't see the class that I talked about this, Firstrade does a really great job in archiving these webinars. They put them on their YouTube channel. So go to the YouTube machine, just search for Firstrade and look at the presentations that I present and see if you can find one on volatility or something. I've talked about it in a number of classes. So we really, in a perfect world, we only want to trade credit spreads if implied volatility is high and elevated. Okay. Now, here's a thing we can do. We can use a nice little rule of thumb to give us some guidance on probability. Now, this is a little bit of a tricky subject to talk about here because this is not really mathematically accurate, but it's a loose rule of thumb. The trader's definition for delta is the probability of an option expiring in the money. So for example, the out of the money option, in this case, put, let's talk about this actual example. This is hypothetical up here with the call. This put has a delta of minus 0.3212 or 8123. We can round that to 0.33, which is 33%. That means that this stock or this option, this put, has a 33% chance of being in the money at expiration. Well, if it has a 33% chance of being in the money at expiration, that must mean it has a 67% chance of being out of the money at expiration, right? In the money means it'll be below that strike. Out of the money means it'll be above that strike. So we can estimate, and again, this is just a loose estimate, that there's about a 67% chance of that trade being a winner. Now, there's a lot of factors that go into that, and it's not really mathematically accurate. So don't hang your hat on that. Don't rely on it. But it can give you just a little bit of an idea. Hey, basically, what's my chances here? So we can take that information and we can say, well, if this put, if the stock is at 43.57 and this 42.5 put has a 33 delta, I only have a 33% chance of not making my maximum profit, 67% chance of making my maximum profit. All right. So there's more criteria we can use here. The technicals on the chart, which we've been talking about some, the fundamentals. So fundamental analysis is a tricky thing. There are some people who are very good at fundamental analysis. These are the Warren Buffett types. These are the Benjamin Graham types, right? These are the folks who read the financial statements, look at the ratios, and can get an idea on what the value of a stock should be. But there's kind of a problem with that. The stock market is not efficient as some of the professors at the University of Chicago, the economics professors at the University of Chicago would let on to. In fact, many stocks can trade above their intrinsic value or below their intrinsic value for many years. If we're trading credit spreads, my guidance is I like to trade them with less than 45 days to expiration, usually less than 30. So the fundamental analysis in the traditional Benjamin Graham and Warren Buffett sense, it doesn't help a ton with credit spreads. The only fundamental analysis that is really helpful is using it to not make to make sure you're not doing anything foolish. Specifically, using it to make sure that you're not holding a position through earnings. Now, why would you not want to hold a credit spread position through earnings? Because earnings can be a very volatile day, and you could run into a lot of trouble that day. So we're going to use the chart. We're going to use the fundamentals as far as looking for volatility events that are scheduled in the news, and then a volatility comparison. So no earnings and nothing else major. Like Fed announcements are a thing these days, right? As far as Fed announcements go, usually lately we've known pretty well what the Fed is likely to do, but what they say is the important thing. hey, we're going to be very patient? Or did they change it and say, well, we're going to be less patient, or we're going to be even more patient with lowering rates specifically? So, that being said, we want to avoid Fed announcements and everything too. Scott says some stocks are really duopolies and trade in tandem. United Healthcare earnings can move Humana earnings. Oh yeah. Oh yeah, for sure. Yeah, that makes a lot of sense. And you see that with, even if it's not like a true duopoly, like the bank stocks, all their earnings came out like last week, right? Yeah, last week. The first ones that come out, they move the ones that didn't come out just yet. At least some. But yeah, good, very good point, Scott. Volatility charts. So you can Google volatility charts and you can find some of these online. It shouldn't cost you anything. But we want implied volatility above historical. We want to avoid volatility events so that historical volatility is not expected to rise during the life of the trade. We want implied volatility to be in the top half of the 6-month range. And we want implied volatility to also not really rise during the life of the chain or life of the trade. That one's kind of the least important, but it's still somewhat important. Basically, we do all that because we want to sell overpriced assets. If you're selling anything, you want to sell them at the best price you can. Like you never want to sell anything under its value. If you do, you're kind of shortchanging yourself. You'd rather sell things over their value, right? Make a profit. So let's look at another example here. So this is another stock. Again, price is not current. Again, hypothetical example. But we've got some support here, we'll say, at $205 a share. The stock's at $211.35. And what do we do here? Well, we've got a couple of different choices. There are different expirations, and we could, well, actually, yeah, we're going to, in this example, use the 10-day expiration. So we could sell the 205 put, which is right at support at $1.38, and then buy the 200 put at 70 cents for protection. So how does that look when it comes to the Greeks? Well, when it comes to delta, there's a couple of important things here. One is, if we're using that loose rule of thumb, this trade has a 23.6% chance of failing, or at least not reaching its maximum profit. So that means that there's a 76% chance of the trade being a winner. Again, loose estimate. But we can also use that delta a different way. If we're selling the 205 puts, that means we're getting long about 23 deltas. But if we're buying the 200 put, that means we're getting short about 12 deltas. So that means we're getting long about 11 deltas. Now, what does that even mean? Well, that means if this stock goes up, say $1, we're going to make 11 cents. If it goes down $1, we're going to lose 11 cents. And that delta does change over time, and it changes as the stock price goes up or down. But that gives us an idea here. So this trade it's not really a bullish trade because it's a small delta, but I would say it's I'm not bearish trade, right? It does have a little bit of a delta. So it does have somewhat of a bias to the upside, but really the the only way you really lose is if it goes down below 205. So let's take a look here. Some people will look at things this way. They'll say, well, I'm going to look at a conservative approach. I'm going to look at stocks that really don't move very much, meaning they have low historical volatility. And that kind of makes sense, right? If the stock's whipping all over the place, you have a better chance of losing. If it's just a nice little boring stock that barely moves, can't say it's more predictable because, the past doesn't predict the future, but, it gives you some context, doesn't it? But the thing is with these slow moving, boring, non-volatile stocks, their implied volatility is low too, usually. So that means we don't really make a lot if we're right, but we can lose a lot if we're wrong. Small chance of a problem occurring. We win most of the time, but we can lose big if we lose. Why is that? Well, because remember, our maximum profit is the credit received, but our maximum loss is the difference between the two strike prices minus that small credit received. So we can have bigger losing trades when they're like that, but we have more winners. What a lot of people call an aggressive approach to income trades is we'll sell high implied volatility so we get some fat, meaty premiums. But when we do that, that's usually because the stock moves around a lot more. The rationale is higher compensation for higher risk, more money, more problems approach. So is that really more aggressive? In a way, yes. In a way, no. You don't have as many winners with this aggressive approach, but you make more on your winners and you lose less on your losers. So which one's really more aggressive? I think you could argue that they're both the same, just different. So to lower risk on income trades, there's a two-pronged approach. We want minimal risk trade structure, and we want to adjust when necessary. Risk management should always be a part of the plan from the beginning to the end of the trade life cycle. So let's break this down. We want to weigh alternatives when we're planning a trade. Do I want to just sell a put naked or cash secured? Or do I want to trade a put spread to limit my risk more? Do I want to do a time spread or do I want to do a credit spread? Do I want to do a 5-day trade, a 12-day trade, a 19-day trade? What strikes do I want to do? I've got actually tons of alternatives. So the way I do this is, most people think, well, I want to get the best risk reward possible, right? And there's kind of truth to that, but it's not really risk versus reward. What it is it's that risk reward relationship versus my payout structure versus my likelihood of success. There's another dimension there that a lot of people don't think about. Let's talk about adjusting here. So a lot of people will do what is called an adjustment. When a trade goes against them, they'll change it. They'll do what's called a roll. Roll up, roll out. There's a roll that I like to call the butterfly roll that we'll talk about in just a second. But here's the thing. We don't like to do adjustments unless we have to. If it ain't broke, don't fix it. Because whenever you do an adjustment, You're locking in a losing trade, but you're putting on a better trade to make it more likely to make that back that money. So let's take a look at this. This is what I call the butterfly roll. Now, if you take notes, this is a good time to be writing some things down here. Let's say you have a credit spread and you want to roll it to a different strike. Well, the way to do that is actually just to trade a butterfly. That takes the credit spread you had and turns it into a brand new credit spread. How does that work? Well, let's take a look. So let's say right now, a trader is short the October 82.5 calls and long the October 85 calls. Short this one, long this one. Regular old call credit spread. Well, let's say the stock goes up and it goes up through the short strike price, 82.5. Say it's trading at like 82.70. Well, that's my trigger for I better do a roll. How do we do it? Well, here's what we do. We're going to trade this butterfly. By buying these October 82.5 calls, that closes these short 82.5 calls. By selling 2 of the October 85 calls, that takes this one long October 85 call and takes it from long one to short one. And then we're adding a whole brand new 87.5 call. So what did we really accomplish? We had this credit spread on, we traded this butterfly, and now we have this credit spread on. See how that works? Pretty clever, isn't it? Pretty clever, right? So that's called the butterfly roll. There are many different adjustment techniques. The butterfly roll is one of the main rolls that we teach here to roll credit spreads, but you can be pretty creative. That was rolling up to a higher strike call credit spread. We can also roll out. We would do a jelly roll for that. Or we could roll up and out at the same time. If we're talking about put spreads, we would be rolling down and using the butterfly roll. Or we could roll out using a jelly roll. Or we could roll down and out. Okay. What questions do you have before we call it a day? There we go. Scott says, oh, iron condor using a put credit spread. Great one. Yes. So when we, and let's go back to the beginning here. When we have this spread right here, and we want to roll it up just one strike. Now, I'm assuming that the strikes are $2.50 wide, right? Goes from 82.5, and the very next strike is 85. And the very next one after that is 87.5. Very next one after that is 90, etc. Okay? So if I just want to roll up a smidge, one strike, from 82.5 is a short call to give myself another $2.50 wiggle room. So 85 is the short call. Then I do the butterfly. No problem. But what if maybe the stock jumped up to like 84? It kind of blasted through the 82.5 strike. And I'm thinking, yeah, I kind of think it's going to stay below 85, but I'm not really sure. It might go above it. I want to give myself a little extra room. I can do a slightly different version of what we're doing here, the butterfly roll, with the condor roll. With the condor roll, what I would do is I would buy one of these, which would close it, but I would only sell one of these, and then I would sell an 87.5 call also and buy a 90 call. If I do that, then I've got all the way until the stock gets up to 90 before I run into more trouble. When do I typically research and plan my trades? Well, some of them I do before the market opens, like my earnings trades. I know many of you are in our earnings class that starts today, as a matter of fact. But some of my trades I do while the market's open, because I mean, this is MTM World Headquarters here. We all are remote people. So I'm always in front of my trading screen. It's open. I mean, it's open 24/7. So yeah, I will usually research and plan my trades during live market hours. Yeah. Good question. But that's going to be, I mean, Justin, that's going to be different for everybody though, really. Everybody's lifestyle is different. Somebody who has a full-time job, they might only plan and research their trades before the market opens or at the end of the day when the market's closed. Or if you're just doing things like covered calls and cash cured puts because you're more of an investor than trader with options, maybe just on Sunday mornings. All right, friends, that is all I have today. Thanks for sharing your time with me and allowing me to share my time with you. And I will see you next week when we talk about long only option strategies. And we're going to be very, very strategic about that. So good stuff next week. I will see you then. Trade smart, and I'll catch you next time. Bye.